What's up everybody, Genix Dividend Investor here. In this video I shared lessons I've learned as someone who's been retired for the last 4 years due to dividends paying all my bills. I'll show you how I just hit a new milestone amount of dividend income at $130,000 a year from my conservatively built multi-million-dollar portfolio in Fidelity. I'll also reveal how my portfolio has done as compared to the S&P 500, and then I'll finish things off by telling you all the crazy details about my health conditions that I've never shared before, the magnitude of which I think will really surprise you. So please do me a giant favor and hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as that's a wonderful way you can help me out. Thanks, I really appreciate it. Feel free to use the timestamps if there are particular topics you want to skip ahead to, but I encourage you to listen to this whole thing as there are little gems throughout which I think you'll value. So this video took me 2 weeks to finish because I had a lot more information that I wanted to share, some of which was kind of sensitive, and it leads me to asking you this question. Would you prefer me to generally keep my videos under 15 minutes, or do you like them over 15 minutes? Please leave a quick comment with your answers so that I can better deliver what the majority of you guys want. Okay, so to begin with, my quick background is that I've been investing in the stock market for around 30 years, starting once I graduated college and got my first salary job working as a programmer at a small company. I've never inherited any money or won a lottery, nor been given anything material, and in fact I started with a negative net worth when I got married to my wife. I worked in tech for all of my career, and beyond programming I've also done a bunch of things in IT, including project management, leadership, cybersecurity, and other techie roles, though I never worked at any of the well-known tech companies like Google or Apple. Now, the main reason I first put money into stocks at 21 years old was because a coworker I respected suggested that I contribute to my work 401k, and I actually had no idea what a 401k was because back then companies didn't push retirement plans like they do now, or at least mine didn't. And speaking of retirement plans, my IRA is the first account of 3 that I have listed here in this screenshot that I took in my Fidelity account on the evening of Friday, September 28th, and it currently has $1.46 million worth of dividend tickers in it. You can also see that overall I have $3.272 million worth of tickers in my portfolio, spread across 3 accounts, with the other 2 being my taxable and the smallest one being my wife's rollover retirement account that I manage. I've been slowly growing my IRA over the last 3 decades, and it's grown to where it is today just from lots of small contributions and compounding. And note, I've covered up some stuff that I don't want to share, like my Fidelity account numbers. Before I continue on, I want to say that as you watch this, I hope you get inspired to invest rather than feel envious due to the size of my portfolio. The reality is that there'll always be people with larger portfolios than you and smaller portfolios than you, but heck, most people don't even have a portfolio, so if you're someone who feels demotivated due to what I have relative to what you have, then I encourage you to instead focus on being proud of yourself for actually taking the time to enhance your financial literacy by watching videos like mine. And trust me, after you hear about all the crap I've gone through due to my health stuff, then I'm confident you wouldn't trade where you are with where I am. One learning I had this last year about retirement accounts is that some foreign countries may not recognize the tax-free status of Roth withdrawals, potentially subjecting you to IRA taxation if you move there. So even though Roth withdrawals are tax-free in the US under certain conditions, such as being over age 59.5 and having held the account for at least 5 years, or withdrawing contributions, you may still face taxes on distributions if you're living abroad, so make sure to research that before you go. Anyway, my IRA is actually a traditional one because Roths didn't exist when I first started, and then I made the mistake of not getting one when I found out about them. You can see that it went up 0.41% on the day I took the screenshot, and that means $5,910 of unrealized gains. Moving into my IRA account, I've sorted this alphabetically by ticker. You can see in total I have $1.46 million worth of tickers in this account, and Fidelity estimates that it will yield $59,299 in dividend income a year. I'm showing this screenshot for people who want to see the specifics of what and how much I hold in this account, but to move this along, I'll just call out what tickers are in here rather than all the details about each ticker, and then I'll provide some more information once I review everything in my Dividend spreadsheet tool. My spreadsheet lets you not only look at each account individually, but it also has a view which adds up all the account positions into one, making it easier to see how much of each ticker in total I own, since I often have the same ticker in multiple accounts. It also has cool graphs of my dividend income over time and how that income is expected to grow in the years to come, along with breakdowns of my portfolio's average weighted dividend yield and dividend CAGR and PE and stuff like that. Plus, my spreadsheet has more accurate dividend income estimates than Fidelity does because mine automatically updates based on changing currency fluctuations as I own a couple of non-US stocks, and because I tend to more accurately estimate go-forward ETF income with the 3 dividend ETFs I have. Now, because I retired around a decade before the normal age where you can withdraw from IRA accounts penalty-free, that means as I take dividends out from this account, I not only pay taxes on it like normal income, but I also pay a 10% penalty. I could do a 72T to avoid that 10% penalty, and that's a section of the IRS code which allows penalty-free access to assets in IRAs under certain conditions, and the condition I'd use is called taking substantially equal periodic payments. I'm leaning towards doing a 72T at some point, but I've not committed to it yet for a variety of reasons, including because I'm still reinvesting some of my IRA dividends, and who knows what the future may hold. One thing I should mention is that my dad was never a fan of stocks, as he said it was like gambling, though I did find out he had some stocks, and he actually had a $40,000 retirement account that he ended up giving or sharing with my mom when they got divorced. So I really appreciate that guy who suggested I start socking money away for my future retirement, as that ultimately changed my life's financial trajectory. Okay, so AbbVie is my first ticker in my IRA, and I have 247 shares of it worth $48 grand, and it's 3.29% of my IRA, and its next dividend pay date is on November 15th, and it's currently at a 3.23% dividend yield, and it should pay me $1,531 a year. In my spreadsheet, you'll see that AbbVie is actually my fourth largest position when I add up everything across all my accounts, and overall I have 181 grand of it, and it yields $1,444 a quarter in dividends, which is $5,778 a year. And if history is any indicator, and it usually is, then I bet AbbVie will announce a dividend hike later this month. I'm guessing they'll do around a 5% dividend hike, so if they do, then my dividend income will go up by about $289 a year. Now, some of you might think that's not much, but it's all about lots of little changes that end up becoming big changes over time. Of course, they might hike it more or less, or maybe not even at all, though I'm pretty confident they'll hike it. Soon I'll tweet a poll on my X account at GenXDividend, where my followers can vote on how much they think AbbVie will raise their dividend by, so please consider following me on it if you've not done so yet. In the poll I ran last year, I see that 17.6% of respondents guessed that AbbVie would hike by less than 3%, then 56% of people correctly guessed that AbbVie would hike between 3 to 6%, and so the 5% AbbVie ended up hiking made those people correct, and then 18.6% guessed that AbbVie's hike would be between 6 to 9%, and 7% thought they'd hike by 9% or more. Okay, and then to quickly call out the rest of my tickers in my IRA, you see BTI, Caterpillar, Colgate-Palmolive, Chevron, Devo, which is one of my 2 income ETFs, Duke Energy, Goldman Sachs, JEPQ, my other income ETF, then J&J, Kimberly-Clark, Coca-Cola, McDonald's, Altria, Realty Income, Pepsi, Procter & Gamble, Starbucks, SCHD, which is my favorite dividend ETF, and then Southern Company, Toronto Dominion, and ExxonMobil. Devo and JEPQ are basically covered call income ETFs, each with their own unique aspects and risks, and they've been great in this bull market, but it'll be interesting to see how they do in a market that declines for years or goes sideways for years. I'm personally fine with a small portion of my overall portfolio in those tickers since the majority of my income is in dividend aristocrats and kings and such, but I'd caution against going too heavy on anything unless you're also okay with its associated downside risks. One new learning I had this year was that Fidelity will show you the next dividend distribution payout for Devo and JEPQ before Schwab and JP Morgan actually list that information on their websites, which was pretty cool to find out. And note, Fidelity displays a payout that is rounded to 4 decimal places of precision, whereas their websites often show 5. Another new learning I had this year was that when you buy Devo or JEPQ, you get a warning in Fidelity before you buy it. This is what their pop-up warning looks like, and it says, "This security is subject to the Designated Investments Agreement, which you have previously signed for this account. Alternative or alt-exchange traded products are publicly offered, SEC-registered funds that use investment strategies that differ from the buy-and-hold strategy typical in the ETP industry." ETP just stands for Exchange-Traded Product. The warning continues on, saying, "Compared to traditional ETPs, alt funds typically hold more non-traditional investments and employ more complex trading strategies, which may carry greater risks. Investors considering alternative ETPs should be aware of their unique characteristics and risks." So basically, the warning people that tickers like this may have more risk than classic buy and hold stocks. Side note, 100% of my Devo and JEPQ positions were purchased from profits from other stocks, and while I wouldn't recommend selling winners if you're younger and still focused on growing your portfolio, for someone like me in retirement, I was okay with the trade-offs of more income for less probable stock appreciation. And speaking of more income, I think we'll probably see a dividend hike out of Starbucks this month, though the new CEO might opt to defer it until the end of next year, and I'll believe that even if he waits that long, it'll still allow them to maintain the streak of consecutive years of increases. I also think Exxon may do a hike this month. One thing you eagle-eyed viewers might have noticed is that I have $532 of cash in my IRA, and it's highlighted because it just came in. And if we take a look at my IRA activity history, then we can see that I just got a $532 cash dividend from Goldman Sachs, which I've not yet manually transferred out into my checking account. I've learned that my dividends become withdrawable between 9 to 11 p.m. Pacific on their pay date. And I've actually configured my taxable account, which I'll show you shortly, to automatically transfer new divvies to my bank checking account, and it takes 1 to 2 business days to show up at my bank. Another learning I had this last year as I was using Fidelity more is that it seems to take about 11 to 12 hours for a transfer from my taxable account to end up in my bank when I do it manually and at night, versus like 5 hours when I do it manually in the morning. I also noticed that my scheduled taxable divvy transfer takes around 30 hours, so I'm guessing that the transfer process does it at batch intervals of time rather than as soon as it hits your account. So if you really want your cash quickly, then it would be fastest to wait until it's withdrawable and then issue a manual transfer. Now, all that being said, I strongly recommend not touching your retirement accounts until you're actually retired. I've had tremendous appreciation and compounding for decades in my IRA, so now it truly feels like an ATM machine which keeps filling up with cash. However, it only got that way because I always tried to get my company matches, and I always socked away some of my salary into my 401k, and whenever I left jobs I always rolled my 401k into my IRA, and I was always reinvesting dividends. The point is that I never took out a dime until I retired. So now it's pretty amazing to have an income stream coming in from what effectively used to be a non-productive asset for me, something I was building for a long time without getting anything in return. And thus a key learning from my experience is that you should at least get your company 401k match, and then either try to max out your Roth or whatever retirement accounts you have at your disposal, especially when you're young. Okay, and then below that Goldman Sachs divvy, you can see a line item that says Early Dist, which stands for Early Distribution that I've been doing, and the cash taken out is $854, which is from the $416 McDonald's dividend shown here, coupled with the $439 Duke dividend also shown here. Then you see another early distribution of $520 of divvy cash, and that came from a $720 realty income dividend I got, of which I reinvested $200 back into O, which shows up here as two separate buys of $188 and about $12. I'm also reinvesting 20% of my Devo, JEPQ, and SCHD tickers back into themselves, and then all the other dividends that come in I take out and use for expenses or emergency savings. When I show you my dividend spreadsheet tool, you'll see a $532 disparity between it and what I showed you in Fidelity because of the timing of that Goldman Sachs divvy and when I took the screenshots. Okay, and then shortly after I started my original work 401k, I opened a taxable account, probably due to other coworkers I respected who talked about stocks when we walked to lunch. My taxable account grew to what you see here, and now you can see it's at $1.6 million worth of tickers, and Fidelity estimates that it will yield $62,847 in dividend income a year. My taxable was also built up over many decades of mostly small contributions along with some bigger ones, like if I got a bonus at work or if I sold a house we were living in for a profit, then I'd set aside some of the profit for my next house down payment and then I'd invest the rest into stocks. So in here I've got Apple, AbbVie, BTI, Colgate-Palmolive, Chevron, Duke Energy, Enterprise Product Partners, my MLP, J&J, Kimberly-Clark, Coca-Cola, McDonald's, Altria, Microsoft, a small position in Realty Income, Pepsi, Procter & Gamble, PM, SCHD, Southern Company, and ExxonMobil. Almost all of them are qualified dividends, which means decent tax treatment, and Enterprise Products Partners, ticker EPD, is return of capital. That means my EPD distributions are at zero taxes for the next 6 to 7 years as each distribution lowers my cost basis, and my one new learning I had this year is that when I got my K1 from EPD, there was a line item which further slightly reduced my cost basis, and once your cost basis hits zero, then you have to pay taxes on your distributions. And speaking of EPD, I think they may do a hike this month in October. All of this stuff about taxes is the learning you should take away from this, and specifically you want to be aware of how different account types and tickers and withdrawals and exceptions and such all impact your returns, and obviously you want to optimize things to best enable your goals. Like taxable accounts are nice with qualified dividends, and MLPs are often best in taxable accounts, and it's probably smart to open a Roth retirement account, and REITs are often nice in retirement accounts, etc. All of that reminds me of a new learning I had this year, which is how 1099 tax reporting works in Fidelity, given I held a REIT and an MLP in my taxable account, something I had never done before. So I noticed that Fidelity publishes a tax schedule for when your 1099s are available, and they categorize things into Group 1, Group 2, Group 3, Group 4, and 1099-R. I wasn't sure what each group represented, so I called Fidelity up and found out that basically if you have only qualified dividends, then you'll probably be in Group 1, which means your 1099 should be available on January 20th. But if you hold a REIT like Realty Income in a taxable account, then a portion of your dividends will probably be taxed as ordinary income and some as capital gains, and Realty Income has historically published their tax percentage breakdowns around January 27th, and thus Fidelity will hold your 1099 until they get all the information from the tickers you hold, which means I'd probably be pushed into Group 2's timeframe for my taxable 1099, which would be February 10th. The 1099-R form is what Fidelity sends to people like me who take early distributions from their retirement accounts. And then the other company of mine which Fidelity would probably be waiting on is Enterprise Products Partners, who issues a K1 tax form. So the TLDR is that your 1099s tend to get grouped into different categories based on when Fidelity receives and processes the tax information needed to release your account's 1099 to you, with later date groups simply taking longer since those tickers are taking longer to transmit their info to Fidelity. Here's a screenshot of my account's tax section on Fidelity that I took in January of 2024 because at that time I was trying to download 1099s for my CPA to do my 2023 taxes, and you can see that my 1099-R was anticipated to be available on January 19th, whereas my taxable date estimated to be available on January 20th, though that date ended up being changed until February 10th due to the O and EPD issues I mentioned. Another learning I had this year was how K1s work due to my EPD position. Specifically, I wasn't sure if my 1099 form from Fidelity would include the K1 form, but it turns out your broker seemingly only tells you if you bought or sold MLP shares and their associated gains or losses, rather than include the MLP distribution income you got, and any income is reported separately in the K1 that you get from EPD. At least that's how it looked to me, but I'm not a tax guy, so don't hold me to that. Anyway, in order to get my K1, I went to EPD's website, created an account, and actually had an issue where they couldn't find my K1, but I called their customer support and they emailed me the PDF, which I then gave to my CPA. And I should probably talk about my taxable account a bit. So as I got more into investing in the 1990s, I formed an investment club with a few other guys, and we actually formalized it as a company because real money was involved and we wanted clearly defined ownership rules and such. Each month there was a minimum amount of cash that you had to contribute into the company's taxable portfolio, though you could always invest more, and then would meet once a week over dinner and chat about what tickers we wanted to invest in. We focused mostly on tech stocks, including IPOs of new tech companies, many of which went under when the dot-com crash hit. Fortunately, we also had some blue chip companies that still exist today, like J&J and Amgen and Cisco and such. That experience of being in an investment club was both fun and educational, kind of like my free Dividend Discord is, which is why I recommend that everyone join up. Anyway, before the dot-com crash, we all felt like rockstar investors because our tech stocks just seemed to shoot up and up and up. But then the market corrected as it always does, and reality smacked us in the face and decimated not only our portfolios but also our egos, and lots of my friends quit investing. It honestly was really harsh to see your portfolio and money get destroyed like that, and it was the first of many crashes I invested through. And that leads to a key learning lesson, which is that you want to keep investing and not quit. Quitters never win in the long run, so while you might need to tweak your investing strategies a bit, you generally want to avoid completely walking away from investing, if you can help it. Taking a break can be okay for whatever reason, but be careful if you take too long of a break. You don't want to do what many people do and wish they had never quit. Sometimes you may have to deprioritize investing if you're struggling to pay the bills, and that can happen. I mean, fixing your broken appliance or that leaky roof or whatever probably makes more sense than adding more to your portfolio. Just invest when you can, budget reasonably, minimize wasteful spending, and go from there. Keep pushing through bad markets, and I'm confident that if you just keep investing, non-stupidly, avoiding FOMO, not falling prey to panic, then you should do well over the long run. I say non-stupidly to stress that you don't need to be smart to do well with stocks, you just don't want to be continuously stupid. I mean, you'll probably make some mistakes now and then, just don't make too many and don't make the same ones and don't make too big of ones. And I'll also say that just investing in an ETF like VTI will probably be better than going with individual stocks, and that's been proven true for the majority of investors in the world, so keep that in mind as you see my portfolio. Anyway, our investment club portfolio actually lost more than the market did when things crashed because we were mostly in aggressive, unproven tech companies, though our boring S&P 500 stocks continued to survive. I say boring in a tongue-in-cheek kind of way, as boring stocks are often the ones that hold up best when Rome is burning. Basically, our divvy stocks lost less when markets were crashing, and me seeing them hold up better is part of what framed me to prioritize divvy stocks going forward. And from that I learned a key lesson, which is that boring is often profitable when it comes to stocks. Solid, steady Eddie companies are usually reliable dividend payers that compound wealth quietly in the background. They just keep chugging along, selling their products that people use, and they often don't get cool news headlines. That being said, I still sometimes bought non-divvy stocks, but I prefer divvy stocks over anything else, and I pretty much always wanted to see my investments have real earnings because I saw what the speculative IPOs did during the dot-com crash. And as you know, the markets came back, only to blow up again in the 07-08 banking financial crash, where again my quality divvy stocks generally lost less. But to give you a flavor for how bad things were in those two crashes, take a look at this chart of Microsoft. From 1999 until 2016, it didn't hold a new high. Can you imagine owning a decent stock for 17 years and it not doing anything? Now, you could argue that it must not be a quality stock if it performed like that, but one thing I learned along the way is that the price of the stock doesn't always equate to its underlying value, and many of Microsoft's metrics were trending nicely even when its stock price wasn't. So to me, it was just a case of the stock price being too low and the market not being rational. Okay, now let me share a bit more about myself. I've been married for 25 plus years, have 2 kids, and I achieved my dream of retiring early once my dividend income was more than my expenses, which occurred around 4 years ago. So my biggest learning is that being retired on dividends works, and is awesome, and everyone I know who's also retired on dividends loves it, and I've gotten to meet a bunch of those people due to my channel. It's kind of funny to hear some people poo-poo dividends, and the naysayers never seem to be retired themselves. Now, there are some legitimate things to be wary of with dividend investing, such as making sure you understand what you're investing in and the risks you're taking on. But bottom line, dividends are one of the two ways companies return cash to their shareholding owners, so if you learn about their pros and cons and such, then I'm confident they'll have a place in your portfolio. Or maybe you enjoy selling 4% of your portfolio each year, and then I'd say great, you do you. I have a playlist of videos on my channel for new investors that I recommend newer folks check out. So it has things like how to start a dividend portfolio, are dividend stocks better, cons of dividend stocks, common misconceptions about dividends, how many stocks should you own, when to sell a stock, my favorite ways to compare stocks, etc., all topics that new investors need to know. If you watch my old videos, then you'll hear other details about me, including my salary history and how I wasted too much money over the years on cars and computers and dating before I was married, etc. And a point is that I never was hyper-focused only on growing my portfolio. Thus, a learning from this is to lead a balanced life of enjoying things in the present, but don't go overboard, and prepare for the future as well. And I stress that because later you're going to hear of some mistakes I made about not maintaining a good work-life balance. Okay, moving on. The last account I'll show you in Fidelity is my wife's Rollover retirement account. It has 209 grand worth of tickers in it, which is much smaller than mine because I made the mistake of not focusing on her investment over the years, and because her jobs made less money than mine, we're always hourly rather than salaried. My wife actually still has an hourly job she loves right now, and she told me that she would keep working there even if we won $1 billion lottery because she loves getting to chat with customers and coworkers and such, and I'm honestly jealous of her because I never loved my jobs. I tried to convince her to quit and then we all move overseas, and she does think that would be exciting, but beyond her job she really wants to wait until the kids are further along in school. Okay, and we can see that Fidelity estimates that the Rollover account will yield $7,742 in dividend income a year. It holds AbbVie, BTI, Home Depot, J&J, Altria, Realty Income, Toronto Dominion, and Travelers. Another new learning I had this last year was when I noticed that my Travelers dividend showed up later than my others normally show up by a few hours, and this was on a holiday, so my guess was that it was tied to that. And since I'm crazy and love to know what's going on, I called up Fidelity, and the rep told me that the delay was probably because Travelers' transfer agent was indeed slow for the holiday. Okay, now let's look at my spreadsheet tool, and then I'll show you in Fidelity how my portfolio has performed as compared to the SP 500, and then I'll finish things off telling you about my health stuff. I'll zoom into my spreadsheet a bit, and we'll go through 3 screenshots worth of my tickers, ordered from smallest to largest, starting with my smallest. So here are my 10 smallest positions of the 28 I own, and I took this screenshot on September 27th. You can see some totals on the bottom, like I have 37,691 shares of tickers, and on the day I took this screenshot I was up 0.44%, which is equivalent to $14,343, taking my portfolio total to $3.272 million, like we just saw in Fidelity. I pull in a total of a little over $130,000 in dividends a year, and my portfolio's average weighted dividend yield is 3.99%, and my portfolio's average weighted dividend CAGR is 5.59%. And before you leave me a comment saying that you could make way more income if I allocated a greater percentage of my portfolio to higher yield tickers, then watch a video I made called Why I Choose Not to Make $325,000 a year in dividends. Okay, my smallest position right now is Starbucks, and I have 311 shares of it, and it's 0.93% of my overall portfolio. It was red on the day that I took the screenshot, and I have about 30 grand of it, and it's currently at a 2.34% dividend yield, and it has a 3-year dividend CAGR of 8.2%. I color code the ticker, pay date, and dividends per pay period in green if the ticker is paying out today, a bluish color if it's paying out within a week, yellow if it's paying out within a month, or white if it's paying out longer than a month out. In this case, Starbucks is in white, and you can see its payout was in the past on August 30th, and when I took this screenshot they had not declared their next pay date yet, but it will probably be around November 30th, i.e. 3 months after the last one, and my spreadsheet will automatically update the date when the data is available. My next larger position is Travelers, and it's highlighted in blue, which means it's paying out within a week, and in this case you can see its pay date is 9/30, and they'll pay me $162 of divvies. Then getting larger in my portfolio are Home Depot, Toronto Dominion, Colgate-Palmolive, Chevron, Kimberly-Clark, Philip Morris, Caterpillar, and Goldman Sachs on the first page of 3 tickers, and Goldman is highlighted in green as it's paying out on that day I took the screenshot, and it paid me that $532 that we just saw in Fidelity. Continuing up, we see next I have Apple at 408 shares, worth about 93 grand, and which only generates $408 in divvies per year. Then Southern Company, British American Tobacco, Coca-Cola, McDonald's, Duke Energy, Pepsi, Procter & Gamble, and then ExxonMobil, worth 139 grand, and it yields $4,579 of Exxon divvies per year. Then moving up to my largest positions, we see Enterprise Products Partners, then Devo, JetQ, J&J, Microsoft, AbbVie, Altria, SCHD, and my largest position right now is Realty Income, ticker O, where I have 3,600 shares of it, and it's 6.9% of my portfolio, and my O position is worth about $226 grand right now, and it generates $948 a month, or $11,384 a year. One of my goals is to see my Realty Income position yielding $1,000 a month, and I'm sure it'll get there bit by bit, based on my small reinvestments coupled with their ongoing hikes. And by the time you're watching this, my dividend ETF SCHD should have split, so I'll go from 2,668 shares up to over 8,000 shares, though of course my overall value should stay the same. And then here's my actual dividend income I've received since I started this spreadsheet in January of 2020, and you can see how my income has been trending up over time. The detailed data from that graph comes from this part of my spreadsheet that I call the Dividends Received Tracker, which shows each ticker I own and each time they paid me a dividend and when. I took this particular screenshot on October 2nd. My longtime viewers might notice a new column that my programmer Main Native and I just added to this sheet, and it lists the total dividends received from each ticker going back as long as the spreadsheet has data of your actuals. So like you can see how AbbVie's paid me about $21,000 in dividends, and Duke Energy has paid me $20,000, J&J also about $20,000, and Altria has paid me $45,000 in dividends. In total across all my tickers I've gotten $445 grand of dividends since I started this spreadsheet, which is pretty nice. At the start of a new month, my spreadsheet automatically adds in a new column representing the new month you've just began, and it lists what dividends you should be getting and how much they should be, and then as your dividends flow in, it automatically adds them in, and of course you can edit what it puts in. On the bottom of each month, it lists the total dividends received as well. So in the first few days of October, I've gotten $1,488 in dividends, and last month I got about $13,000 of divvies, and the month before that I got $10,373 in divvies, etc. One really motivating thing I like to do is to look at how my dividend income has trended up over time per ticker. Like take a look at McDonald's, starting with its first dividend payment I recorded here in March of 2020 for $503. I was stripping McDonald's dividend at that time, aka I was reinvesting it, so next quarter my payout increased to $507 in June of 2020. Again I dripped and it got to $510 in September. Then they did a small 3.2% dividend hike, taking me to a $528 payout in December. It made sense that McDonald's did an uncharacteristically small hike because that was in the midst of the pandemic. That's also around when I retired and turned off my drips, which meant my payout would probably only increase once per year when they did their annual hike. Okay, and again in March of 2021 I got a $528 divvy, and every 3 months afterwards I stayed at that same payout amount until we hit December of 2021 and they did a 7% hike, taking my quarterly divvy to be $565. Then again it stayed at that amount for each payout until we got to December of 2022 where they did a 10% dividend hike, taking me to $623 a quarter. Then I kept getting $623 per quarter until we got to December of 2023 where they did a 9.9% dividend hike, taking my quarterly payout to $684.70, which is where it's at now, and I bet we'll see a smaller McDonald's hike being announced sometime this month, maybe even between the time I finish this and the time you watch it. And that McDonald's example highlights the power of dividend growth over time, and a key learning is that living on dividends should teach you about the power of delayed gratification. Of course, building a good portfolio takes time, which is a learning in itself, and the compounding and growth aspect become more and more noticeable as time passes and your quality companies keep growing and hiking their dividend. Dividends aren't a game for those that gotta have instant results, but honestly the best things in life take time. It's pretty amazing to me to be able to own part of the McDonald's company, and to know that their profits are helping to pay my mortgage and my family's health insurance and stuff like that. If that isn't mind-blowing to you, and it should be, then I recommend you watch a video I just did called Do Dividends Increase Your Wealth, where you'll see the math behind how reinvested dividends increase your percent ownership in a growing company. And obviously you want to invest in quality growing companies and not declining ones, because who wants to own more of a declining asset? Focusing on quality investments is another key learning, especially if you want to have higher odds of continually growing income. I love good dividend stocks and have benefited from the compounding effect that dividends can create, and the dividend snowball should not be underestimated. So let's add compounding to the list of learnings, specifically to understand their power over time. Even small dividend payouts can significantly grow your portfolio as they reinvest and then compound your returns, kind of like interest on interest. Yes, things start out slow, but then that snowball can become more and more powerful, and hopefully you've seen how small decisions you make today can result in amazing long-term results. Another core lesson I've learned is that inflation is a constant threat, but can be manageable with good dividend stocks. I mean, clearly inflation erodes your purchasing power, but dividend-paying companies with a history of increasing payouts, like McDonald's, can outpace it and often do. That's part of why fixed income strategies aren't as compelling to me as dividend growth strategies. My divvies have consistently outperformed inflation over the long run, and you have to own quality dividend companies for that to happen. And all that leads to another learning, which is that financial independence and retiring early or retiring better is a mindset enabled by action. Living on dividends requires a plan, frugality, discipline, and ultimately long-term thinking and action. If you can prioritize wealth generation over the short-term pleasure of spending, then you'll achieve your retirement dreams. Your financial freedom can come if you can change your habits and if you can create a lifestyle that makes true financial independence achievable. Okay, moving on. Here's a graph of what my spreadsheet estimates my go-forward dividend income could look like over the next 10 years, with the blue bars representing no drip, i.e. if I'm using all my dividends to pay my bills, versus the red bars which represents how fast my income would grow if I was reinvesting my dividends with the drips on. I'm reinvesting a small portion of my divvies, so hopefully I'll end up somewhere between the two, though realistically I'll eventually have some dividend cuts or suspensions, and sometimes my companies won't hike as much as they used to, so it's just an estimate but not guaranteed to be true. And here's that same data but looking out over 35 years, and it really makes it visually apparent how reinvesting your dividends should accelerate your income growth. And then this data shows the actual numbers behind those graphs. The top line is the no-drip data, starting at the current point of $130,000 of divvies per year, and growing based on the portfolio's average weighted dividend CAGR. You may notice a small delta between my annual income from my other graph because the spreadsheet is constantly updating things like changing currency conditions, which also impacts estimated income. Okay, so like 1 year out, this estimates my income would be $137.7K if my dividend CAGRs hold and I was spending all my dividends, or I'd be at $143.1K if I was reinvesting them. Year 2 it says I'd be at $145.4K in the no drip line versus $156.9K in the drip line. And year 10 this estimates I'd be at $224.7K of income if I was spending my divvies, or $318.6K if I was dripping them. Then if we look even further out, let's say to year 30, where the further we go the less likely it is to be accurate, we see a crazy amount of dividend income in the no drip row of $667,000 a year. And then an even more insane annual number is if I drip my dividends over the next 3 decades, then I'd theoretically be pulling in over $1.5 million a year in divvies. Wouldn't that be amazing? Now realistically we also have inflation which eats away at this, and I actually have an inflation adjustment input field if you want to see how your buying power would grow when you factor that in. Another fun view of the data is in the middle of the screenshot, showing how I make about $130,000 in divvies per year, which is about $10,900 per month, or about $2,500 a week, or $357 a day, or about $15 an hour, every hour, even when I'm sleeping or watching movies or whatever. I also estimate an average wage hour of equivalent dividend income, where it assumes you work X hours a week and you get vacation time, and that your dividends are qualified in a taxable account and blah blah blah, so it doesn't pertain to my exact situation, but it helps make the point that a dividend dollar tends to have more buying power than a wage dollar, and that the hourly average passive income you see on the bottom is far more powerful than an hourly job income. Moving on, here's a quick breakdown of my portfolio value by sector and my passive income by sector. So like on top we see that consumer staples is 16.3% of my portfolio by value, and on the bottom we see that consumer staples is 11.2% of my income. Or like sin stocks are 11.5% of my portfolio by value, but are 21.4% of my dividend income. I wouldn't recommend sin stocks to anyone trying to grow their net worth, but I personally find it a reasonable risk for my retirement income. Of course, just because I do something doesn't mean you should. Okay, now before I show you my performances compared to the SP 500, I first want to do a quick shout out to Financial Modeling Prep, aka FMP, the company I'm now using to get accurate near real-time stock data into my dividend spreadsheet tool, as multiple people have asked me who I get my data from. FMP has historical prices, fundamental data, insider transactions, and much more, all of which goes back 30 years in history. I recently switched to using FMP for my dividend spreadsheet that my Patreon aristocrats and kings gain access to, because the API I used to use shut down, and after researching tons of companies out there, my programmer Main Native and I chose to go with FMP, and so far it's been awesome. They have flexible pricing options for personal use, starting from free and going up from there as you need more. They also have flexible commercial pricing options, and I work with a really helpful guy at FMP named Samuel, and he crafted a deal that would work for my needs. I've included my affiliate link in the description of this video in case you're looking to get great market data into your software, and my link should get you 25% off their personal plan prices, or 10% off enterprise plans. Okay, now let's take a look at how my portfolio has done as compared to the SP 500, as that's a common question people ask. First, it's important to mention that I moved into Fidelity about 3.5 years ago from E-Trade because I got annoyed when E-Trade had a system outage just as I was wanting to do a big buy, and because Fidelity was offering me cash to move. Fidelity has a tab that lets you see your portfolio performance as compared to the indexes like the SP 500, and you can see that I selected 3 years, and it says my portfolio has returned 39.16% in total, beating 35.34% of the SP 500. I took this screenshot on Monday, September 30th before the market opened, as that's when I started working on this section of the video. I was surprised to see that my portfolio was beating the SP 500 in a bull market, especially since I'm holding some income ETFs and sin stocks, and some tickers that I'd have guessed wouldn't grow too much. I mean, I've built my portfolio with the belief that it should often outperform in declining markets rather than outperform in bull markets, especially since I'm in a stage of life where I'm more interested in asset retention and income generation than portfolio growth. I do hold some positions primarily for growth that have super low dividend yields, like Microsoft and Apple, and it's also important to realize that this is only 3 years of data, so don't conclude too much from a relatively small time frame. When I select the 5-year return in Fidelity, then it doesn't show my portfolio returns at all because I've not been there that long. And if you're wondering how my portfolio is done from the time I started investing in the 1990s, then I recommend you watch the most emotional video I've ever made called The Time I Sold All My Stocks. And then here's another view that Fidelity has, which I took midweek as I was working on this video, and it shows my 3-year annualized returns at 12.32% per year, as compared to the S&P 500, which has returned 11.91% per year for 3 years, which is crazy good. Okay, so we saw Fidelity's summary view where I'm at $3.27 million in my portfolio right now, and if I look at my video I did last year called What I Learned in 3 Years, then you'd see that I was at $2.77 million 12 months ago. That's $500,000 of appreciation and compounding in just 1 year, which is awesome, especially since I'm taking out all my dividends. A learning might be that sometimes you'll beat the market, but also realize that over the long run you probably won't. And I want to be super clear that I don't expect this sort of overperformance to continue, though if we went into a down market or a sideways market for multiple years, then I think I might outperform on average, and if things keep trending up, as they normally do, then I'll probably underperform. Obviously, it's not that I want to underperform, but I'm purposefully sacrificing potential capital appreciation in order to get more passive dividend income. I've built a fairly conservative portfolio that enables my goals of being retired due to my dividend income being higher than expenses, dividends which I hope will continue to grow faster than inflation on average over the long run. Hopefully you should be cluing in that there aren't big secrets to do okay in the market. Let's just keep investing, don't be stupid, and don't quit. Okay, back to Fidelity. This screenshot also shows the geographic exposure of my tickers, and I'm at 96.7% North American companies and 3.2% UK. Now, I should also say that before I retired, I was more focused on stock appreciation and total returns, but now I'm not, and again, my needs are different than yours. Like my kids' accounts have some non-dividend growth tickers in them, like Amazon, but they also have some tickers with divvies in them that I think will grow, like Microsoft. Basically, I'm not focused on income for them, but I still stay in the S&P 500, and something like 80% of the S&P 500 pays dividends, so naturally most tickers they own will also be dividend tickers. I think part of the reason I've done okay in the market is because I have a diverse portfolio of decent stocks, and I tend to buy when things are cheap and try to only sell when they're expensive, though I try to never sell. These days, my favorite way to assess if something is cheap or expensive is using fast graphs, and because I value them so much, I'm now an affiliate for them. As an example, I mentioned I'm slowly dripping part of my realty income into itself, and part of the reason why I'm doing that is what you see here. The black line is its stock price over time, and right now it's underneath its blue line, which is its historic price per AFFO, aka a REIT's equivalent to price to earnings. Thus that means it's looking cheap right now from how the market has historically valued the stock. Plus it's basically touching its orange line, which is representative of a fair value estimate for realty income using Graham valuation formulas. Or to say that differently, right now realty income looks cheap, or at least fairly valued, depending on how you look at it. And you can see how its price trended down as inflation rates got high, which makes sense because companies like O deal with mortgage debt and such, and dividend stocks as a whole are less compelling when risk-free rates are higher, like what you can get with treasuries, though banks and money market accounts are also often seen as lower risk. So to me it makes sense to buy more realty income when it looks cheap, combined with the fact that I want to increase my position. And thus another learning is that buying tickers when cheap should enhance your returns overall, though it's obviously easier to just keep dollar cost averaging in regardless of price, and for many people that can be a great approach. You should spend some time learning how to value stocks to determine if they're cheap or expensive, and I built some spreadsheet tools to help me do it, but now I prefer using fast graphs, as that's much better than what I built. Let's take a look at another ticker I talked about in McDonald's to see what fast graphs estimates. Right now its black stock price point is far above its historic blue line market price trend as well as above its fair priced orange line trend, so probably quite expensive. FastGraphs also has future growth estimates, and the future is what you're really investing in, and all their information is stuff I really value when analyzing a stock. That being said, a lot more goes into my decision making before I buy something, but price is one key aspect. Feel free to watch a video I did called Buying Dividend Stocks on Sale versus Market Timing, which explains why buying something when it's cheap is different than timing the market, at least from where I sit. Okay, now let's switch gears and I'll tell you about some crazy health things that I've never shared before. So backing up a bit, it's helpful to know that from the time I was in high school, I got big into working out and staying healthy. I ate right and bulked up naturally, and ended up being a gym rat for decades. After our first child was born, my wife convinced me to go to the doctor to get a physical, because I had told her that when I was playing high school sports, they had identified that I had a heart murmur, but it never seemed to limit all the stuff I did in life. Now, a mistake I had made was thinking that my loud and powerful heartbeat was normal, and that it getting louder must be from it growing and getting larger, just like all my other muscles were. It made sense to me as I was constantly pushing myself to grow. Anyway, I went in for a physical and my doctor told me that I should go see the cardiologist, and short story long, they told me that I was like one of those athletes that you see running down the field and suddenly falls over dead. Basically, I had inherited a bad heart valve from my dad, and my heart had gotten bigger and bigger over time as it was working more to compensate for my bad valve, and I had aortic regurgitation and such, and bottom line, it wasn't good. So they immediately scheduled open heart surgery to fix me up, and back then they weren't doing minimally invasive heart surgeries like they can do these days. The crazy thing was that I was basically the last person on earth that my friends thought would ever have any big health issues, because I was the guy who was always working out and eating right. But such is life. Right after my surgery, I started having amnesiatic episodes, as I previously mentioned, and they've lasted for decades. These episodes come on randomly and usually last for a few hours, and I know who I am and where I am, but I'll often keep asking the same question over and over, and my short-term and medium-term memory usually is wiped out until I get back to normal, and sometimes even long-term memories can be gone. I'm basically out of commission when I have one of these episodes, and I couldn't even tell you what all my tickers were, and might not be able to log into a website. And even if I could log in, I shouldn't, because odds are I do the same action multiple times. Over the years, I've talked to tons of specialists literally all around the world, and have done many tests and tried different meds and various medical devices, and tried different diets and a slew of other things, but no one's figured out why my episodes actually are or how to stop them. I dealt with having these memory issues when I was working some of my 9-to-5 jobs, and I was always worried that I'd be in a meeting or presenting something and I'd have one of them, but fortunately I was able to keep my issues under wraps. It's really a freaky thing to lose your memory, but it's happened so many times to me over the decades that while it still sucks, I know that if I just wait it out, then I'll get back to normal again. So it's been kind of an inconvenient, scary thing that kept happening to me, but it wasn't a showstopper. No, the real showstopper happened more than a decade after my first open heart, and that's when I got a massive stroke, which actually was multiple strokes at the same time in different parts of my brain. The doctors still aren't exactly sure why I had the strokes, though one guess was that it might have been due to my replacement valve breaking down over time, even though they had been checking it every year. I say that because when I got my second open heart surgery, this time to replace my replacement valve, the surgeon said that he had never seen such a beaten up tissue valve before. And I'm sure that the toxic and stressful work crap I put up with for years didn't help things either. My stroke hit me when I was sitting in a building lobby out in public, and I remember I had a coffee in one hand and was looking at a phone or Palm Pilot display in my other hand. My arm started feeling weird and I began losing my vision, and the coffee I was holding dropped to the floor on its own, like I wasn't holding it. I remember thinking that I should call my wife, but then I realized that I didn't have the manual dexterity or the vision to manipulate the phone. I kinda called out for help, and a guy sitting nearby recognized what was happening to me, and he and another dude helped me out of the place and into a car, and I got rushed to a nearby hospital. It turns out that the guy who was driving me was a retired former ER doctor who made a split-second decision that driving me to the hospital would be smarter than calling an ambulance, which apparently they aren't supposed to do because of risk and liability issues. But I guess he knew that typically ambulance drivers are not trained to administer stroke clot-busting drugs, and so he figured my best odds would be achieved by him taking me to the hospital in his car. Now, a big disclaimer, I'm not a medical expert in any of this, and what I'm saying may be incorrect, and if you're ever in a similar situation, then it's probably smarter to just call 911 rather than do anything else. Anyway, as he drove me to the hospital, I remember that things looked blurry. On the way, I think he called ahead, and when we got there, people were waiting outside to rush me to the hospital. I got shuttled into some room, and I don't remember much, but I do remember a doctor asking me a couple of questions to seemingly gauge if I was with it enough to understand and respond, and then he asked me the big question. He said that there was a medication called TPA that had a good chance of helping reduce long-term disabilities, sometimes caused by strokes, but that there was about a 5% or so chance of serious issues resulting from using it, including brain hemorrhages and even death. And bottom line, did I want to take it, and he needed an answer right then. I told him yes, let's roll the bones, and then I don't remember much until I woke up in the recovery room. Now, if you want to hear something really sad and pathetic, it's that I remember recovering in bed and thinking how awesome it was to be in the hospital, because it was the first time I was not being contacted or paged due to something breaking or whatever at work in over a decade. Like, I'd been on infrastructure support teams where you have a pager rotation, and usually the less infested the systems are, the more they break down, which means the more support you have to provide to keep them going. I'd been in management positions where the CEO was insane and smacking his underlings around non-stop 24/7. Like, once I was called back from a vacation my family and I were taking in Europe because they wanted me to do a presentation to some bigwigs, and I was the best one to do it, even though my direct boss had approved my vacation 6 months previously. I actually had just gotten a new boss at work, and I was literally emailing him some stuff from the hospital, and that's when he called me to see how I was doing, and he said the best thing I had ever heard. He told me he was going to check the logs from this point forward, and if I even checked email or logged into any system at work, he would revoke all my access. Basically, he was saying, WTF what are you doing, dude, you gotta rest. That all probably sounds insane to you, and it is, and unfortunately it highlights that some jobs I didn't have any work-life balance at all for literally years, and that's clearly not smart or sustainable, so learn from my mistakes. Like I remember my first job out of college, I was surprised if I left work and actually saw the sun, because we were always working crazy long hours. Anyway, various doctors and family members visited me as I recovered in my hospital room, though one person that really stood out was a doctor who apparently was the guy who reviewed my initial MRI scan, and he was surprised that I was sitting up in bed and talking to people. He later told my wife that he thought I'd be catatonic given the amount of damage that my brain had sustained. Bottom line, I was fortunate that I didn't die, and that my strokes didn't do even more than they did. But now I'll whine a bit and tell you about all the things that did happen to me. So most parts on the left side of my body now have reduced sensation or numbness. I lost a portion of my eyesight, which is why I can no longer drive anymore. Now to be clear, my eyes are fine, but the portion of my brain that my eyes interact with got partially nuked, which makes it so that a portion of my sight is basically just not there. Think of it like you're looking through your iPhone camera and a quarter of the upper left part of the screen is covered in tape. So because of that, I now need to look around a bit when I walk, or I can bonk my head into something that I previously would have automatically seen. Fortunately, if you met me in real life, you'd not be able to notice that anything was wrong with me. Like my face doesn't droop and I don't walk with a limp or really anything visible, and I'm grateful for that. Initially I had trouble speaking, but over time that improved a ton. But still to this day, certain word combinations are harder for me to say. Anyway, I remember when I was in the hospital and I took my first post-stroke shower, and post-stroke shower is a word combo that is hard for me to say, and I had a nurse in there with me to help me out, which probably isn't as fun as you might think it should have been. And when I raised my left hand to my head to wash it with shampoo, I bonked myself in the eyes due to overcompensating with my left arm because of its reduced sensation. I also couldn't walk right after my stroke. I went through lots of physical therapy where they started me off in a walking harness that was suspended from the ceiling, and as I got better I started using a walker and then a cane, and finally later I was walking without any support. That whole experience of slowly getting better with walking and then jogging was actually pretty cool. Like one day at home I was practicing walking and I decided I needed to stop using the cane and start to walk on my own, and as the days went by I kept pushing myself as I wanted to jog, and suddenly I had a breakthrough one day where I was able to jog and maintain my balance, and it was literally like a light just went on in my body. It was like my neurons suddenly grew and reattached, and voila, I could jog and keep my balance. These days I can jog and even run, though I'm way slower than I used to be. I had to relearn how to walk up and down stairs, and to this day I still am careful when I'm hustling up or down steps. Beyond that I used to have awesome night vision, but afterwards it became terrible. I lost some of my visual acuity and some colors are now muted. I went from having an amazing sense of direction to having an atrocious sense of direction, but my iPhone's GPS has become an awesome tool for me. Some of you might have noticed that sometimes I speak faster and sometimes slower, and that's because my internal ability to self-pace isn't as good as it used to be, and when I'm passionate about something I naturally talk faster. I went from being able to play 3D maze games and remembering most of the map after seeing it once, to hardly being able to remember any of it. My typing speed went from being around 100 words per minute with almost no errors, to being at 20 words per minute with tons of errors. But as the years went on I got better and better, to where I'm now around 90 words per minute with just a few errors. I went from being someone who could curl 100-pound dumbbells multiple times per arm, to not being able to curl 20 pounds on my left arm. And then slowly my strength and control has gotten a lot better, but I'm still way down from where I was. And my overall memory is pretty crappy compared to where I used to be. Like right after my stroke, if I looked at an object, let's say a house, and then I closed my eyes, I literally couldn't remember almost anything that I had just seen. I mean, I'm better than the guy in Memento, but I've gotten in the habit of needing to constantly use notes and texts and emails to myself in order to remember certain things. And if I meet someone new, then the likelihood that I'll remember them is pretty slim, unless they have something that really stands out about them. But as the years passed, I got a lot better. I used to love to play more fast-paced video games and watch action movies, but right after my stroke my ability to absorb information was materially reduced, as was my manual dexterity. Plus my ability to follow a complicated plot was also negatively impacted. But that also caused me to start watching slower-paced movies that were more character dramas, and I ended up being exposed to a ton of movies that I ended up really liking that I might not have otherwise have watched. And as the years went on, I improved a ton. I'm not to where I was before my strokes, but now I can absorb information way faster, and I can once again enjoy action movies and play faster video games, though not as well. And there are other little things which happen which you probably wouldn't even think of. Like every so often at night I'll wake up and will find that my covers have been pulled away from my left leg, which then gets cold and wakes me up. But on my right side that doesn't happen. So TLDR, I went from someone who was on a college track team and played full contact sports, being someone who moved a lot slower and more carefully. But I did gain a whole new appreciation for how some older folks must feel in society. Like now I understand how it might suck to be in the middle of a big crowd at a stadium, where people are jostling one another as they move, and balance is more of a challenge, combined with tons of stimulus that can be tough to deal with. And then to add even more fun to the mix, I ended up having another stroke a few years after my first ones, though fortunately that one was minor in comparison. Another fun gift I still have is that now I sound a bit like Captain Hook. Specifically, my second valve they put in was a mechanical one, and it ticks audibly. I wish I had gone with a mechanical valve for my first surgery, but that's another story. Anyway, because of my ticking, I now hold a pillow over my chest when I'm recording audio so that you guys don't think there's a clock in the background. So between that and all my stroke stuff, I've had lots of fun health things I've dealt with at a relatively young age. I was talking to my son this week, and he was saying how he would really hate it if he had any of the vision things I have, and yet here I am, and I'm the happiest I've ever been in my life. Dealing with all the health stuff helped me realize that I need to be grateful for what I have, not mad for what I lost or don't have. Simply being alive means I've won the lottery of life. Thus, a big takeaway from all this is to be grateful, as the most important things in life are your health and your relationships and all that corny stuff that you might not really appreciate until you lose them. Be happy if you can drive a car. Be happy that you aren't living in a war-torn country. Be happy if you can see or hear. Imagine how hard life might be if you were blind, and yet when was the last time you really appreciated the fact that you can see? There's a great quote that goes, "Good health is like a crown that the healthy wear, but only the sick can see." It means good health is often taken for granted by those who have it, symbolized by the crown that healthy people wear, and those who are sick or suffering can see the health that others have. I now understand how fortunate I am, taking everything into consideration. I'm happy that I can smell fresh flowers and that I can go outside and take walks with my wife. I love being able to feel the sun streaming down on my face, something I never reflected on when my health was perfect. I'm grateful for my family and what we do have, and I'm so appreciative that I get to make videos for all of you. So I urge you to try to value what you have, not stress about what you don't have. That doesn't mean don't push for goals, but also don't stress about it, and bottom line, think about and appreciate what you do have. The next time you put on a pair of cozy socks, then take a moment and be happy that you can see them and feel them and put them on. Appreciate that you can take a huge gulp of fresh air and hopefully not feel any pain in your lungs. And if your current realities suck, and or maybe if your portfolio isn't where you want it to be, then still strive to find things to be thankful for. Being thankful doesn't minimize the bad things that might have happened to you. Besides, you never know what your future will bring, and sometimes your best times will come after your worst times, so just try to work hard and push through tough times, and I'm confident your future will be brighter. So even if you're sitting there and telling yourself that you can never build a portfolio like mine because of where you are in life, and you regret a bunch of things you've done in your past, then I'd like you to focus on the fact that you can't start the next chapter of your life if you keep rereading the last one. What I mean is that I can understand that you've made some mistakes, as everyone has, and you wish that you had done things differently, or maybe you just have had crappy luck. And I hear you, but I ask you to try to start focusing on the future rather than be irked by your past. What matters now is what actions you take from today going forward, and if you invest carefully, then I'm confident you'll do well over the long run. Everyone has hard times and tough experiences they go through, and your situation and realities might be worse than many people around you, but know that you can make it through any challenge that is thrown your way. You can help build your future by what you do from here on out. Sure, the market could crash right after you invest, and you might feel down about that, but I think if you just keep moving forward, then eventually things should turn around quite nice. Anyway, beyond me realizing that I should be grateful for the health I still have, it's also important to mention that I'm super grateful for my dividend portfolio as well. It honestly is one of those things that brings me a ton of pleasure as well as gives me a lot of hope for the future. I can kinda understand how J.D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Remember, at the time Rockefeller was the richest person in US history, primarily due to his wealth accumulated through the Standard Oil Company, and he had a modern-day equivalent of $340 billion. Standard Oil dissolved in 1911 after it was deemed to be an illegal monopoly, and it got split into dozens of independent companies, some of which later merged to become two companies I'm currently long in, aka Exxon and Chevron. Now, dividends definitely aren't the only thing that gives me pleasure, but I really do love getting them on so many levels. Like the fact that they've given me my time to do whatever I want each day is simply amazing to me. Having more hours with my family, for working out, playing video games, watching movies, whatever, makes each day something I appreciate even more. Every day is like the weekend to me now, and my dividends have made my life so much better. The reality is that my health stuff made keeping a job, or getting a job, harder to do, even though I managed to do it for many years. Thus, dividends have given me financial freedom, which has also made my health issues easier to deal with. Dividends now pay for my Uber rides, and having the freedom to be driven somewhere that I want to go is awesome. My dividends are used when I pay for Amazon stuff and when I use Grubhub or Instacart, services which give me a huge sense of independence that I'd otherwise not really have due to my inability to drive. Side note, I can't wait for level 5 autonomous driving to come, because that will be yet another aspect of freedom for me, a freedom that I used to have but really didn't appreciate. So hopefully now you have a better sense of why I value passive dividend income so much. I mean, even when I'm out of commission due to my recurring memory issues, or even when I'm sitting in a hospital room, my dividend cash keeps flowing into my accounts. Plus I have a decent probability that I'll have another stroke, and who knows where that will leave things. I don't dwell on that possibility, but I'm just being real. I also believe that medical technology will improve significantly due to AI, and that can better help me to improve even more. So because of the freedoms my dividends have given me, combined with the realization of how fortunate I am, and because of my belief and hope for what the future will bring, well, that's all why I find myself being the happiest I've ever been in my life. My divvies are a gift that keeps on giving, something that has materially made my life better, and they continue to astound me. Like tomorrow it'll be October 10th, and that's when my MO and PM dividends both come in, and it's crazy to think that my MO dividend alone will pay out more to me than my monthly mortgage, even after taxes and penalties. So divvies not only pay for the roof over my head, but they also are building up equity in my home, along with generating lots of spare spending cash. Truly amazing. And if my dividends didn't come in and my emergency cash had run out, then I could always consider selling stocks as a backup plan. But for years my divvies have been paying for the food I buy and the clothing I wear, etc. So as someone who has amnesiac episodes that can hit 24/7, kind of turning me into a vegetable for a while, having true passive dividend income which keeps flowing in is life-changing for me and my family. Bottom line, finding out about dividends and of course investing in quality dividend stocks has been one of the things in life that I'm most grateful for. Dividends aren't magic, and your companies need to keep flourishing for their divvies to also flourish, but divvies honestly feel like magic, and having a bit of magic in your life is something I really love. Anyway, it was all the health crap I went through that also influenced me to start creating dividend videos, as I wanted to document my investing experiences and perspective for my kids in a way that they like to consume information, aka YouTube, and while I originally was going to create private videos just for them, my wife convinced me to share them publicly. And I'm really glad she did because I've loved this new hobby of mine, and I feel like I found my calling in life to help influence people around the world to invest. It brings me a lot of happiness knowing that I'm bettering people's financial realities over the long run, or at least in theory I'm doing that. I want everyone to be able to experience how amazing it is to get truly passive dividend income, and the longer I'm doing it, the more I love it. Another reason I do social media stuff is because it's good to exercise my mind, especially in retirement, so learning about audio and video stuff has helped my brain continue to heal and grow. That reminds me of a comment I got this year from someone named Tonessa98 that asked, "How do none of your family members or close friends know that you're a self-made multimillionaire if you have a YouTube channel and you talk about that stuff?" And another subscriber named Yippee77777 asked me, "What do people think you do?" So the answer is that only my wife and kids know about our net worth and the fact that I do YouTube stuff. My best friends know that I'm working on something, but I've not told them what it is. Most people close to me know that I'm into investing, so my guess is that they probably think I'm retired due to stocks, or maybe they think I'm on disability due to all the crap I've been through, or something. Honestly, no one has ever asked me about it, not even my close friends. Anyway, another thing I love about doing social media is seeing my subscriber count trend up and my viewing hours trend up, kind of like how I like seeing my characters get stronger in MMOs, or when playing D&D or whatever. To me, doing social media stuff is a super fun hobby, but it's not something I do for money, even though I do appreciate making money with it, because it's another stat that I like to see go up, and it lets me give more to my relatives and charity, and it's something I've used to show my kids how they can start a business online and can grow if they don't quit. I basically had zero audio and video experience before I started creating videos on YouTube, and in fact I barely even watch YouTube. So if I can do it, they can do it. So can you. I've recently started talking to my son about how I could help him start a Twitch channel because he loves playing video games, and I think it would be a great experience for him to learn how to build something online. A key to success on social media, and everything in life, is to pick a topic you love and then keep pushing for it. Persistence is key to achieving any sort of success, which is a learning you should take away from my experiences. Take a listen to this great 80-second clip which highlights what I'm talking about.
My research team and I went to West Point Military Academy. We tried to predict which cadets would stay in military training and which would drop out. We went to the National Spelling Bee and tried to predict which children would advance farthest in competition. We studied rookie teachers working in really tough neighborhoods, asking which teachers are still going to be here in teaching by the end of the school year. And of those, who will be the most effective at improving learning outcomes for their students? We partnered with private companies asking which of these salespeople is going to keep their jobs and who's going to earn the most money. In all those very different contexts, one characteristic emerged as a significant predictor of success. And it wasn't social intelligence, it wasn't good looks, physical health, and it wasn't IQ. It was grit. Grit is passion and perseverance for very long-term goals. Grit is having stamina. Grit is sticking with your future, day in, day out, not just for the week, not just for the month, but for years, and working really hard to make that future a reality. Grit is living life like it's a marathon, not a sprint.
So if you want to have a better retirement, and I'm very confident you can, then push for it. Invest in quality tickers and persist through the tough times and get back on the horse whenever you fall off, and you'll achieve things beyond your wildest imagination. Moving on, another key learning you should take away from this video is that your income doesn't have to come from your labor. Sure, it starts with your job, but then once you buy the asset, it can potentially be an income producer for the rest of your life, regardless of what you're doing. You can choose to take your dividend cash now, or even better, you can reinvest your divvies to compound your growth and make your future retirement income even better. Plus, eventually you can pass your dividend stocks onto your kids or to charities or whatever, which is another important lesson to realize. I mean, you can literally be the person to start a financial legacy that provides for you and potentially generations of others. Moving on, a logical question you might be asking is if now is a good time to invest. I mean, these days we see some big investors going more into cash, seemingly indicating that the frothy valuations have them concerned about a big crash coming. Many investors have been likening our current AI tech bull run to the dot-com crash, and while I see some similarities, I also see some key differences. Like back then, the birth of the internet was causing extreme lunacy and irrational exuberance among many investors, myself included. I witnessed how a company would just add the word web or internet or .com to their name, and suddenly their stock would shoot up 30%. But those companies had no earnings to speak of, and pretty much all of them crumbled. However, today's Magnificent 7 tech stocks actually have huge earnings, but they also have way elevated PEs like they did back then. And while I agree that there's a lot of hype around AI, like there was a lot of hype around the internet, and I agree that prices are expensive right now, my guess is that AI will be as revolutionary to our society as the internet was. That all being said, I could also see the market falling 50% tomorrow because anything could happen. Regardless, a key learning I'd like to impart is that patience and calmness usually lets you win in the stock market. If the market crashes and your companies are still producing goods and services that customers want, then why would you freak out and sell? Why not just let it ride, remaining patient for the market to come back to normal, as it historically always has? And while you wait, you keep getting your dividends as they come in, and you can reinvest them to increase your ownership in the company, or you can use the divvies to pay your bills. But have the patience for your dividend strategy to do its thing. That doesn't mean be obstinate and refuse to acknowledge that you could have made a mistake in your investment, but perhaps be a bit more reflective before pressing either the buy or sell buttons, and instead have patience for things to play out as they logically should. And that leads me to another key takeaway, which is that you should learn to value simplicity. Investing in blue chip dividend stocks is simple. They are well-known, straightforward companies with easy-to-understand business models. Simplicity often outperforms complexity when it comes to investing. So rather than chase the next big thing, instead just focus on simple investments with reliable results, ideally at good prices. And my final takeaway that I want to leave you with is that good dividend stocks let you sleep well at night. Dividend-paying stocks, especially from blue-chip companies, often provide peace of mind as they tend to be less volatile and offer steady income. Ironically, many investors expect investing to be stressful, but with a focus on solid dividend-paying stocks, your portfolio can feel like a calm, reassuring presence, not a source of anxiety. And as I move past my 4 years of being retired due to dividends, I find that sleeping well at night is something I value more and more. So I don't get rattled when the markets crash, and it doesn't matter to me if markets continue to shoot up. It just matters that I have a diverse portfolio of tickers that continue to do their thing. So now I'd like to ask you a question. What percentage of your retirement income do you think you'll get from dividends? Is it less than 33%, 33 to 66%, or more than 66%? Please leave me a comment with your response so that everyone in the community can see it. And with that, I'll ask that if you got any value from this video, then I'd really appreciate it if you hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my videos. Also, please consider sharing this video with someone that you think it might help, as you could literally be the person who positively changed someone's financial future by exposing them to something they might not be aware of. Okay, now I'd like to do some shoutouts. First, I'd like to shout out Edward M., who signed up as a Patreon aristocrat. Next, I'd like to shout out JVA USA, who also signed up as a Patreon aristocrat, but for an entire year. And finally, I'd like to shout out Mainly DC, who also signed up as a Patreon aristocrat for a full year. I also want to show you all my channel members. Thanks, I really appreciate everybody's support. Now I'd like to recommend that everyone check out my FastGraphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you try out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but since my Patreon Aristocrat and King seats are often sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you'd probably like. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.